How to trade weekly options on SPX is what we're going to cover in this video, and it's actually a replay of a live workshop I did for trading SPX put credit spreads with 7 days to expiration, and is an update to all the previous versions. So this is the latest version as of 2021, and I really think you should watch the entire video so you get the full trading plan details and the mindset and the results and the backtest. You really want to take all of this in, because I really want you to walk away from this video knowing exactly how to trade this on your own. And so I think watching the entire video is really going to help that, especially during the Q&A period towards the end. And if you'd like a copy of the PowerPoint that's shown in the video that covers the strategy so you can take it home and have the notes and everything, I'm going to put a link in the description here on YouTube. We'll tell you how to get that. I'll email it to you. Also in the description of the video on YouTube, you're going to find additional SPX strategies and resources for 0 DTE and some other ones that I trade with members. So be sure to check those out as well. Now let's get into the SPX 7 DTE weekly options workshop, and we're starting right now. So let's get started. What we're going to talk through tonight is the SPX 7 DTE strategy. I've been trading this for a couple of years. I've had a couple different iterations, and basically it's a strategy that's kind of easy to follow. Many of you are probably already trading this with me if you're over on Patreon. I've posted this in the network, and actually let me bring that up. Just so you know, when you're in the stock market optionstrading.net site, if you go to discovery, you can go down to the featured section, and this 7 DT put credit spread strategy, I posted this, I think it was in February, so 5 or 6 months ago, and we were trading a certain version. So what I like to do is, every few months, 6 months, I like to rerun the back test, if you will, and I make little adjustments to see, hey, is there anything that can be improved? Sometimes, you end up with a losing streak or something. You're like, okay, well, maybe we should make adjustments, because the market, it's always changing over time. I typically run a 5-year look back period when I do my back test. And I know some people, we get into disagreements about this, but some people, well, let's back test 10 years. And it's like, well, I don't know that something 10 years ago is going to work today. So I like to keep it relatively fresh. And I think with the COVID crash, that actually gave us a good little mini bear market, even though it was a big bear market, but the time frame that the bear market was there was very short. So that's something we had never seen before. And some people will get caught up with, well, what about 2008, which was a little more prolonged bear market? And some of the software we use, we can't actually go back that far. And weekly options on SPX, that's what we're going to be talking about today. They actually didn't have weekly options like that back in 08, I don't think. I think it might have been Fridays only, and then eventually they added Mondays and Wednesdays. So, I just kind of go with that five years is my number. It's easy to do. And I think, when it puts out 200 trades, I think that's a good, that's enough trades to sort of validate whatever it is you're trying to validate. So, but anyway, under the discovery section, you'll see the featured area. We have disclaimer, the rules. This is, important. But if anyone wants to go back to this version and kind of see what it looked like 5 months ago, you can do that. So what we're doing is basically we're updating this back test in this, I call it a workshop. So real quick disclaimer: trading stocks can be, and options and everything can be risky. It's not suitable for everybody. This is for informational purposes only. Shouldn't be construed as a recommendation. I am not a financial advisor. I'm just a regular person who likes to trade. I like to share my ideas and the tools that I use. And if you have any questions, you may want to contact a professional. Enough about that. And real quick, here's a couple resources that we're gonna I just want to touch on real quick. So the free trading community is stockmarketoptionstrading.net. It operates like a Facebook. So if you're not on there already, come over and join. It's free. People are posting ideas, different trades that they take. We do some back testing there. I know there's a lot of other backtesting users there. And there's a few people using eDelta Pro. That's the software I'm going to use tonight. And just for full disclosure, I'm a paying customer of eDelta Pro, but I'm also an affiliate. So what that means is if you were interested in that software and you were to sign up using my link, I created this short link for you. I do receive a small commission for that. It's very small, but it's something that helps pay for my software, and I can put out these videos. So you can go to optionstrading.help/EDP, and that'll take you to that if you're interested in that software. I think they charge you $100 a month or $400 a year, I think is what they do. So it's you pretty much want to sign up if you're going to do that for the year. And then this strategy that we're going to talk through tonight, this is one of the strategies we trade with members over on Patreon. Patreon is sort of like my premium blog. There's alerts. There's a few other strategies similar to this one that I do backtest on. So there's a way, an easy way to support the research and all that stuff over there. And many of you are already over there, so I appreciate all that and all that support. So just wanted to distinguish the two sites. And at some point, I may try to get everything in one place, but right now, this is how things are operating online. So before we get into all the details, I wanted to discuss, and a lot of the stuff I'm going to put here is stuff that I have to remind myself whenever I'm looking at a strategy, because I know you've read a book, you've watched the videos, you've probably maybe backtested something, and there's certain strategies, and there's just a million things out there. And so whenever you're learning a new strategy, these are just some sort of tips that I put for this presentation. It is really just to kind of be open to new ideas. And, and just for this next hour or 45 minutes, however long we go, just forget everything you've learned about options so far. Forget about IV, forget about 45 days to expiration, and just not that you should forget about how that stuff works, but just be open to different approaches. And because something we're going to do tonight, I think, is a little bit different. And again, many of you have seen it before. But the other thing too is, and I'm really guilty of this, is try to see this through a little bit, and don't necessarily try to put your own twist on new strategies until you kind of explored whatever was presented to you. And I see this a lot because there's so many indicators. I try to get it as simple as possible, but if you're using other indicators and things, and you're going to get conflicting messages, and sometimes you'll have two systems that both make money, and on one particular trade, one's going to say take it, and the other one's going to say don't take it. And one of them's going to be right, and that could be a loser for one strategy and could not be a loser for another strategy. But ultimately, both of those can still make money. So I sort of kind of get in the camp of, let's just stick with one system from now. And then if you want to add in and work on things on your own later, that's great. But that's just kind of, a little bit of a tip. And that's something I've been guilty of. So less is more. Let's not overthink this. And we're really going to be kind of just focusing on probabilities. And that's things ultimately where we all end up, especially with options, because there's some built-in probabilities. And what we're trying to do is basically find a better probability to sort of establish an edge. So I wanted to throw this in here too, because the hardest part about some of these trades is that the trade itself is very simple, but sometimes it's hard to put on. And really, to make money trading, you have to find an edge in the market. And what we're going to, what I try to do is find an edge through some sort of consistent thing that we can do that makes money over time, so that we don't have to watch the market all day. I do watch the market all day, but not for every trade. And ultimately, you have to believe in whatever the edge is. So if you can't define the edge, it can be hard for you to take that trade, because again, you're going to see the market, this is a bullish trade we're going to talk through tonight. You're going to see the market doing something crazy, like a sell-off, and you're going to be nervous to take that trade. But that's the edge. You have to be able to take the edge. So you have to have the confidence to take that edge and take that trade when that opportunity presents itself. So you're going to have to be able to execute on the edge in a consistent manner. I still struggle with this. Sometimes, I'll skip trades, mostly because I might feel like I'm too levered one direction or the other. And the other thing is you must understand and accept the risk for each trade. And one of the things we'll touch on a little bit tonight is just the risk. And we're going to be talking about the defined risk spreads. So we're going to do credit spreads tonight. And before you enter that trade, we know exactly what our max gain is and our max loss is. So if you know your max loss is, let's say, $300 for a trade, you need to accept the fact that you might lose $300. That's what accepting the risk is. And this is something that that is talked about in Mark Douglas's book, Trading in the Zone. It's one of my favorite books. And you need to be able to execute on that edge, but also accept the risk. And one of the things I see a lot with credit spreads really is that people don't accept the risk because they want to minimize that risk by using stop losses and things like that. So what I've done to mitigate some of those big losers is we actually trade a little bit closer to the money, so the credit is greater and the max loss is less. But if you're trading something that's very, very far out of the money, like a Delta 10 or Delta 20, and your credit's just this big and your risk is this big, then yes, you may need to employ a stop. But as you move up and down that scale of how close you are to the money, the risk and the gain sort of adjust as well. So you have to find the spot that you're comfortable with the risk. And this is what we're going to talk through right now is what I'm comfortable with. I understand the risk. I know how much I can risk. And ultimately, you have to believe in your system. And the way that I've become more consistent in the past few years is basically, by backtesting and seeing the results and just saying, man, if I just did this and I stayed consistent, I'll make money over time. So that's kind of just a little bit about, having an edge and executing. And you need ultimately a macro belief on your system. And that's what we're going to look at tonight. But then you have to execute that each week or each time that opportunity presents itself. So this is just kind of a quick snapshot of my several strategies, actually 4 here. My SPX end of day trading calendar. So we're going to be backtesting in eDelta Pro, and eDelta Pro uses end of day option pricing. So all the strategies that I use from eDelta Pro should be executed at the end of the day, as close to the end of the day as possible. A lot of times, we'll take these at 3 or 3:30 Eastern, 30 minutes before the close, something like that. But I just wanted to kind of put this calendar up here is what I'm trying to do. The trade we're going to talk about tonight is the Wednesday trade. It's a 7-day to expiration PCS. DTE is days to expiration, PCS, put credit spread. And it's conditional. And what conditional means is that we're going to use a moving average condition that's going to let us know if we should take the trade or not. And we'll talk through that in a second. So what I've tried to do is sort of come up with strategies that work best on Monday, strategies that work best on Tuesday, Wednesday. I've really had a hard time finding a good Thursday strategy, at least with SPX. I've got some covered call stuff that I do there. And then I think recently, I think it was episode 29 of the podcast, I talked through a conservative, what I kind of term as a conservative strategy that we're taking these trades on Friday. So it's a 60-day put credit spread. And then we have a monthly hedge that kind of goes with that. So these are the strategies that we're trading over on Patreon. But we're going to talk through the one for Wednesday here. And let me go ahead and bring up the backtesting software. Okay, so we're gonna do this backtest from scratch. This is eDelta Pro. You can see that I have a million different things here, and some of them are more experimental. But we're going to do this one from scratch because I want you to see the software. And I know a lot of people out there are using eDelta Pro. And sometimes I'll get a message that says, hey, I set it up, but I'm getting different results. So I kind of want to show you how I'm setting these up, because there are some little parameters that you can adjust, mainly to do with the width of spreads and the, what do you call it, the delta or the DTE variance. So anyway, we're going to start from scratch. And we're going to come off the knowledge that we already know in this point that Wednesday has been a better day for this. So we're going to just stick with Wednesday for now. And just real quick, we're going to put in our ticker. We're backtesting SPX. We're doing 5 years. We're going to be short a put spread, and this is going to put a short put here and a long put, and then you can adjust the width and all that. So what I like to do is I double click on this and I can link it. So that way, what we're first going to backtest is selling a Delta 48 put. That means that it's typically the first put out of the money, and we're going to buy a put that's 5 points lower. So on SPX, this would be a single strike wide put spread, or 5 points wide, but it's a single strike wide. We're going to do 7 days to expiration, and we're going to trade this weekly on Wednesday. And before we get into that, in this little gear icon, there's a allowed DTE range. And since we really want to narrow down on Wednesday only, I'm going to narrow this down to 0. So it's only going to do it on Wednesday. And the reason why that is sometimes, let's say the market happened to be closed on Wednesday for a holiday or something like that. What the software would do is maybe pick a Friday and then becomes not 7 DTE. So I try to really get it narrow. And then if for whatever reason that week, that Wednesday, the market's closed, then we simply just wouldn't do that trade. And we also want the width to be very narrow, the delta match. So we really want this to be Wednesday 5 wide. And even with these settings, sometimes the software is going to make it of 10 wide, and it, there's a couple of them that are a little bit wider, but this is the software we're kind of working with. But those are the settings I typically use. It's only going to take one spread at a time, and it defaults to 100,000 balance. You can change this here. I don't really pay attention to that. So that's the one setting that I think, if you're using the software, you can kind of play around with when you're doing these back tests. So the first thing we're going to do is we're just going to run this without any filter. And we're just going to look at, if the last 5 years, from July up to July 30th, this is a couple of days back, if for the last 5 years we took this trade every Wednesday, no matter what, what would that look like? So we're going to go ahead and run that. Sometimes these can take a minute, but once these are established, we'll have them all over here and we can kind of flip back and forth between them. But I wanted to kind of start with, without any sort of filter, meaning we just take every trade. So you can kind of see what that looks like. So, and what I might be able to do here is, that might be too big. That might be a little better for you guys to see. So let's go down to the results. And I think it's important that we kind of factor in all these things. If this is something you decide you want to trade, there's a lot of things to look at. In this case, it made a little over $7,000. So if you think about that, a 5 wide spread is, your average credit here in this case was $197. That means your average risk was about, I'm going to call it $300, maybe $310. So if you're risking $300 a week for one contract, this is what that made over the last 5 years, $7,000. So it's a pretty significant return. That's averaging $50 per trade. That's combining all the winners and the losers. We might want to call that expectancy. So if you're risking, let's just say 300 per week, and you're averaging $50, then that's, I don't know, 15, maybe not 20%, but 15% or so gain per week. Now we know that when you're selling this put credit spread, if we're averaging, our average win is 100, I'm going to just round this to $200, and our average loss is $300. Most of the time, one of those things is going to happen. You're either going to make your full credit, you're going to make that max gain, or you're going to make that max loss. Sometimes it lands in between, and there can be a partial gain and a partial loss. But for the most part, you're going to see one of those two things happen. So what this average 50, that doesn't mean that each week you'll make 50. I just want to be clear. This is just the combined, the expectancy when you average that over time. So in this case, we had a 70% win rate. It took 144 trades, excuse me. You'll see that this max loss was $595, or the largest loss, I should say. And typically when you go into the log file, which I'm not going to do, but you can go through each trade. Sometimes you'll see one that maybe took a 10 wide spread, and where the credit might have been $300 or $400, but you lost, you had a max loss on that wider spread. So again, there is no perfect software. But let's look at the P&L curve. So, 70% win rate, did pretty well for a while. And you can see in 2020, there was a pretty big drawdown with the COVID crash. And you actually had some pretty big drawdowns here. So, just by blindly taking this trade every week, this actually did pretty well. The reason I don't like to do that is because we don't really know if there's going to be a prolonged downturn. And that's something I mentioned before. With the COVID crash, it was very quick. We had a downturn of a couple months, and then it was kind of back off to the races and was very choppy down here. But ultimately, we had a nice run back up, and it's been a pretty good run the last, let's call it year or so. So someday, the market is going to go down again. I know it seems impossible, but it will. And I like to have what I call a bull market filter, or some kind of conditional thing to tell me that that the market, maybe we shouldn't trade this week. And sometimes that means giving up a little bit of your gains, but it's actually a lot easier to trade. So real quick, I'm going to flip over to a price chart of SPX, and I want to talk a little bit about moving averages. For the past, I don't know, probably year or so, we've been trading this using the 8 EMA and the 21 EMA as a bull market filter, and basically saying that the 8 EMA, or excuse me, if the 8 EMA is above the 21 EMA, we're going to consider that a bullish condition. So therefore, on that Wednesday, if the 8 EMA is above the 21 EMA, then we would go ahead and take the trade, or we're going to tell the software to take the trade. If for some reason the 8 EMA trades below, like in the COVID crash, the market goes, would go lower, then the 8 EMA would cross below, and then on that Wednesday, you would not take the trade. So this can kind of keep you out of some of the larger downturns, and that's something that, I think is pretty valuable. So we're going to go back to the software, and we're going to add this in. And by the way, we're simply holding to expiration here. We're entering the trade at the end of the day on Wednesday, and no stop, no target. We're just letting it go, and wherever it lands, it lands. So we're letting the math play out. So I'm not utilizing any of these fields down here. So we're going to come into the filter, and we're going to add an EMA filter. And what we're going to say, backtest, is say we're going to do the 8 EMA is above the 21 EMA. Now, for those that are using eDelta Pro, you may know that there's some moving average issues with using SPX as the reference, but if you type in SPY here, what this will do is it'll look to SPY, the moving averages of SPY, which is pretty close to SPX. It's not exact, but it's close enough to where this will be a good moving average reference. So when it looks at SPY, it's going to say, is the 8 EMA over the 21 EMA? Yes. Okay. Is it Wednesday? Yes. Okay. Take that trade, the Delta 48 spread. So I'm going to come out of here. So now we have that technical filter. This is what when I put on my calendar, it's conditional. And let's go ahead and run this again. And so whenever you add a filter like this, you know that you're going to have a lesser amount of trades. And that can be good, that can be bad. We're going to see the difference here. But ultimately, what we're trying to do is not trade, not put money in the market, or at least into this trade when the conditions aren't optimal. So let's scroll down a little bit. So you can see the first thing is we do have less trades. We have 104 trades. The win rate's a little bit higher, 72%, but you actually made a little bit less money overall, but you made on average more money per trade. So this is the trade-off. And if I click over here, this is more of a quick comparison of the two. So at this point, this becomes more of a personal decision about which one you prefer. Some people look at the P&L and say, well, I want to make more money. And that's great. If you want to make more money, at least the last 5 years, this one made more money. But again, I have a hard time with that because I don't know that we're going to be in a bull market forever. And if we get into an extended bull market, I don't maybe want to, deal with an extended period of losers, for example. So we can see that it still lost money during the COVID crash. So there was still a little bit of a downturn there. But ultimately it kind of rose up. And so, it's because this is a short-term bullish trade, it tends to follow the SPX in the general, kind of bull market. So again, the trade-off here is you get to trade less. You had 40 less trades, 144 trades versus 104. So that is about 40% less trades, but you're making only, maybe 20% less in actual profit. So it's a trade-off. It's, whatever one you feel like you want to do. And this is where people start to get into their own analysis. And when you add your own analysis about your prediction of what the market's going to do over the next 7 days, then you're at that point, you're not trading the strategy anymore. You're trading your own analysis. And that's where that consistency to believe in the edge sort of that I mentioned before, that's something that you got to try to factor in. So I'm guilty of that as well. So that's the one we've been looking at over the last year. We've been trading that. So what we're going to do now is something very simple. Is we're going to come in here and we're basically just going to change the 8 EMA to the 3 EMA. And I tested all kinds of EMAs. I typically use the Fibonacci numbers. That's where I get these numbers from. So 1 + 2 is 3, 2 + 3 is 5, 3 + 5 is 8. That's where we get 8 from. And then 5 + 8 is 13, and 8 + 13 is 21, and so on and so forth. So those are the numbers I use for my EMAs. That's where I get those from. I know, you could probably do this with a simple and a 5-day simple and a 20 simple, something like that. But that's just kind of where I get those from. So we're going to run this with the 3 EMA over the 21 EMA. While that's running, I'm going to go back to the chart here and let's just turn that. I'm going to add the 3 EMA. And if you just kind of look at this, it's actually pretty similar. So the 3 EMA is in white. You have the 8 in green and the 21 in blue. So in a typical bullish kind of market run, the 3 is going to be above the 21 and the 8 is going to be above the 21. So it's not that much different. The part that you'll see that's a little bit different is when the market does turn down, that 3 EMA is actually going to turn down much sooner below the 21 versus the 8 EMA. In this particular case that we're looking at, that was actually not good because if this was a Wednesday and you sold that spread, that actually would have been a profitable trade. So there are times where there's the quick dips, the 3 EMA, using the 3 EMA is going to keep you out of there, but it's also going to get you out of an extended downtrend sooner. And the same thing coming back into the trade. And I don't know if I can find a good example here, but here both of them came through. But on this particular day, let me zoom in a little bit, the 3 EMA crossed back above. So if this was a Wednesday, you'd be in this trade, whereas the 8 EMA, you wouldn't. So that's just kind of the handoff. I don't want to get to which one's better. We're just going to look at the back test. It should be done now. So let's take a look. And again, 104 trades, very similar to the 8 EMA, but actually made a little bit more money. So it made $60 per trade, and it made a little over $6,000. So when we compare the 3, the first one here was take the trade every week. 144 trades had a 70% win rate, versus the second one is the 8 EMA over the 21 EMA. Improved the win rate a little bit, made less money because you're not trading as much. But the 3 EMA actually had a little bit better stats than the 8 EMA, and this is the one that I'm going to be trading now. So 73% win rate, made it a little over 6,000. You're making on average $60 per trade. That's when you combine all the winners and the losers together. And again, if you're risking about $300 a trade and you're making 60, that's about a 20% gain that you're making. And so if anyone, correct my math too if I say anything wrong. Sometimes I misspeak, but anyway, that is the 5-wide version. So I wanted to stop for a second, and in a second we're gonna do 10-wide, which is a 10-point wide spread. I'm going to show you there's some benefits to that. but I wanted to pause for a second and let me know if you guys have any questions so far. Feel free to put it in the chat, or you can unmute yourself and just ask.
Yeah, I had a question just in terms of the way you're calculating the percentage.
Mm-hmm.
The 20%. To me, I mean, that technically is right, but I need more of a portfolio approach in terms of the size of the account,
Mm-hmm.
and then how many contracts would you trade? How much risk would you put on?
Right.
2%, 5%. Because if you had if you were doing it just by the margin, you could have $100,000 account and go all in, but you'd be risking 60% of your account, and I think you'd blow up. So
yeah, don't do that.
Yeah, no, I'm not. I'm not going to do that. But it's kind of like seeing a profit and loss curve with a certain size account with a certain percentage size risk. I don't know if that software can create that, or
yeah. And this is a good point, and it's something I get questioned about a lot. So the way I look at this, and I don't know if Lee is on tonight. He's really good with this type of stuff. But here, so let's do this. If we know that our average gain is about $192 and the average loss was, I'm just going to say your average win is 200 and your average loss is 300. So from a risk standpoint, I would not risk more than 1 or 2% on the trade. The other thing you have to keep in mind is what else you're trading, and this is just how I look at it. So, for example, I trade a lot of short-term bullish stuff, so I lean more towards the 1%, 2%.
Okay.
Because I may have another trade. I did a video or an article on broken wing butterfly, which is a very similar trade, but it's on Monday to Friday. Well, if the market tanks at the end of the week, both those trades become losers. So I try to keep aware of my just net delta exposure on shorter, different time frames, if you will. So that's something that's really hard to do. We're kind of looking at, and this is a good point, we're looking at this trade in isolation. The way I kind of look at it is, maybe what we can do here is, let's say instead of 100,000, instead of looking at this as our portfolio, let's look at this as like, okay, I want to allocate for 25. Let's say $5,000.
Oh, okay, 5,000.
Right? Because the software is only going to take one trade at a time. You know what? Let's do 3,000. Right? So let's say you dedicate, and by dedicate I mean you're going to allocate $3,000 to this trade. And again, just to be clear, I'm not a financial advisor. I can't recommend this. I'm just trying to help make the math seem a little bit more normal. So I'm going to go ahead and run this, and we're going to get the same results, but we're going to look at the difference here. So if we allocated 3,000, so let's say you have the $100,000 portfolio, and you say, okay, for $3,000, for 3% of my account, I'm going to trade one contract of these. And the reason why you need to think about that is because when you have let's say you have 3 or 4 losers in a row, and you lose $300, let's say you have a bad month and you lose 4 times in a row, and you're losing $300 per trade, you're going to have lost, $1,200. Right. So you can't just go in with saying, I'm going to put the whole thing on there, because you don't have any room for losers there. Does that make sense? To kind of.
Oh yeah, for sure. I mean, even with $3,000, you're risking 10% per trade, which is
no, you're still only taking one spread per $3,000.
Right.
So you're risking $300 per trade of your $3,000. The rest of the $3,000 will be in cash.
Right.
So you're only risking, of that $3,000, yeah, you're risking 10% of the 3,000. Maybe that's what you said? I'm sorry.
Yeah.
Okay, sorry. So that's kind of how I look at it. Is I want to allocate, however you want to term it, a certain number, and this is just an example. Let's say it's $3,000. So if I allocated $3,000 to this trade, I'm only trading one contract per week. That means most of the time, most of it's in cash. That's where a lot of my money is. My options money is in cash, and I'm allocating money because I know when I have losers, the account's gonna, it's gonna do this, but over that, over that period, this particular version made about $6,200. So that $3,000 that you've allocated turned into $6,000, but you only traded $300 of risk at a time.
Right.
I don't know if that helps or not. I know that's
that does help. That does help.
And to be honest, it's something I'm still working on too, because I have several of these style where it's like, okay, you're going to trade this one every Wednesday and trade this one every Friday, and kind of making sure that you don't get over leveraged if the bear market comes, or you wake up to the next COVID, Delta variant's been knocking on our door. Who knows what's going to happen. So I know that if the market blows up next week and I have 7 trades where I'm only risking 1% per trade and they all blow up, then I'm going to be down 7% in my portfolio. But I know that I also have a lot of cash that I can, do other things with. So any other questions about that, or any other comments? I'm definitely open to other people chiming in on this type of thing. Someone wants to see, what about just doing the past 2 years and not 5 years, because we've had the crazy bull run? Sure, we can do 2 years. And we'll stick with the $3,000 allocation. There is not a way to do compounding inside the software. However, you can download the trade log, and I think it spits it out as an Excel file. So that is some things you can do with the software. And I'll show you the trade log here in a minute once this one runs. This is a 2-year. Bulk of the trades, bull run. Okay, so over the last 2 years, this is how this did. You can see this was the COVID crash, and then it recovered. And these flat lines, that's typically when the moving average condition isn't present. So during the COVID crash, the 3 EMA was below, so it might not trade it for a few weeks, and you get back in, and then kind of does that. So that's why you have these flat lines here, and then ultimately, so this is what it looks like over the past 2 years. So it made a little bit less money per trade over the last 2 years. It's still at about 70% win rate. Yes, you can download the trade log from eDelta Pro. And yes, you could add compounding to it to yourself if you were to do that. I cannot backtest more than one contract at a time. So you're just going to have to extrapolate these results. Go back to the 5-year. If you sold 10 contracts versus one contract, it would just simply be 10 times that. Does the software itemize 104 trades? Yes. Any promotion on the software? There's a promotion if you sign up with my link, because I get a credit, but I don't have any pricing promotion for that question. Let's go ahead and look in the trade log just so you can see what this looks like. So what the trade log tells you is the date, the price of SPX at the time of that date. It tells you the strikes that it took, the entry price for each one. In this case, you got a $170 credit. That means the margin was 330 because this was 5 wide, and held to expiration. This one experienced max gain, and you can see the very next one experienced max loss. And so you can we'll just kind of gently scroll through these numbers. So you might have several max gains in a row, and then here's looks like a partial one. This must have landed between the strikes somewhere, and then and then your max loss comes, right? So you can experience a couple max losses in a row, and you have a couple max gains. So and this is where you just have to have enough cushion to absorb the losers. That's why you don't want to go all in with your, if you have especially if you have a small account, let's say you have a $3,000 account, $5,000 account, you really only want to trade one of these, because you can see that you can have multiple max loss losers, right? You can also have multiple winners here. And something to just kind of understand about probabilities is the distribution of the wins and losses are completely unknown, right? We're looking at this one snapshot back in time, but moving forward, the pattern of wins and losses is going to be completely different. But given that we're taking over 100 trades, 140 trades, something like that, that's enough, evidence, if you will, for me to say, okay, I'm going to trade this. I'm going to allocate. I'm going to risk, 1% per trade of my account. So for me, I might do a couple contracts for my options account per week. Sometimes it changes a little bit, but yeah, you can download this to Excel, and then you could probably, for those who wanted to do compounding, you could probably do that. Let's see. Is the thinking correct? Okay, let me scroll back up. Someone wants to take profits early. Good questions. Have you thought of other indicators other than EMA? So start with that. So yes, I have done EMA. I've done SMA. The problem is, in this particular software, the only real filters I have are moving averages, IV, RSI. I've done some various things with that. And the simplest one was just, hey, is the market in a bullish condition? Yes. Okay, take the trade that says, hey, just be flat to higher over the next 7 days and you make money. It's the simplest one. The other thing was, when you're trading things with short term like this, because we're using end of day options pricing, and end of day, even with RSI, it's going to look at the end of the day number. And at that point, there's no intraday getting out with a stop or loss. So someone asked, can we take profits at 50% of the max profit? So yes, we'll do that. But what this is going to do, it's going to look at the end of each day. So if you open this on Wednesday, the next day, it's going to say, have you achieved 50% profit? No? Okay, wait till Friday. And so it doesn't do it throughout the day. There's no intraday. It's not like you're going to, if you were to put a GTC order that says, hey, buy the spread back for half the credit that I got, 50% max profit, the software isn't going to do that. It's going to wait till the end of the day, which is fine for the max profit. But when you talk about a stop loss, that could blow through your stop loss, and then it's going to close it. So this is why when you're using this particular system or end of day backtesting, that it's really hard to backtest stop losses on short-term spreads. But we'll go ahead and run a 50% max profits just so you can see. So this one was the 2-year. I'm going to remove that one. So this is 5-year without and 5 years with. Okay, so we did 5 years this time with a 50% max profit. And a couple things that does. One, it actually improves your win rate. You went from a 73% to a 78% win rate. So if that makes you feel good, great. I don't think it's enough for me, because the profit was, to me, significantly less. You're averaging 42 per trade, or $4,300. So that's almost 30%, 25, 30% less by taking profits early, at least 50% profits. Let's do 75%. That did a little better, of course, because you're booking profits, you're booking more profit. And as expected, it's a little bit lower win rate here. So not lower, it's lower than the 50%, but higher than the no profit taking. So, there are some options here. Maybe 75% is better. Maybe this is good enough. 56, that's actually pretty close to 60. So you could take profits early. And reality, I do this a lot. Like if I feel like the way I kind of approach this is sometimes, let's say SPX is trading at 4,300 and you have the 4,300 put credit spread, and 7 days later, it's at 4,301 and you're really, really close. I'll often close this early because I don't want to risk some late day fade blowing the whole thing up. But if the market has rallied and if you have a lot of room, 10, 20, 30 points, then a lot of times I'll try to let it hang in there as long as I can. But I am known for taking profits a little bit early. But, you know, to systematize a certain number, I think cuts you a little bit short. But I will close the trade early if I feel like there's any other risk in the market. So there are some real world implications that I try to factor in. So someone asked, is the thinking correct to assume that the past 5 years of this backtest is to help outline what the next 5 years might turn out to be? In a sense, what we're trying to establish here is that if the market's in a bullish condition, that selling a bull put spread just below price, that the market would stay flat to higher over the next 7 days. I do expect that that's going to play out. I do expect that that's going to have a positive expectancy. I think that can be profitable. Will it be as profitable? I don't know. If we look at this, you know, there was a period of time where it wasn't that profitable, right? But then there's a period of time where it's super profitable. So this is what I expect. I expect it to be all over the place, but I expect it to go from the bottom left to the top right over an extended period of time. That's the macro belief, but I have to understand that I have to keep it small because I can have those, you know, a series of losers or a period of time where it doesn't work. Okay. Are you personally doing these trades weekly? Yes, I personally trade these. These are trades I send in alerts over on Patreon. So we've been trading this with members for probably a couple of years now. We've changed it a little bit, but this is the updated version. Huge max drawdown. Yeah, there is a drawdown here for this one particular strategy, as any other strategy, I guess. Instead of stop loss on profits, what about changing the stop loss on the losing side? Instead of taking max loss, can you filter it so it takes you out of the trade at a loss of $200 and $250? In this software, I can only choose a stop loss percentage. So let me, but again, you can't really, what's the word? Because when you think of stop losses, if you put a stop loss order in, your brokerage platform is going to be constantly checking to see if that stop loss parameter is hit. And if it's hit, then it's going to close it, let's say at 1 p.m. on a Friday or whatever. But the backtest software is going to wait till the end of the day. And if it's exceeded that stop, then it will close the trade, but you'll have lost more than that is. So we can do a stop loss here. I'll do 100% to run it, but I can't believe this unless what you're going to do is every day you're not going to have a stop loss order in and you're going to wait till the end of the day. And if at the end of the day that stop loss has been hit, then you would close it yourself. So that's, to me, just, it's not a realistic thing. I wish it did intraday. This is something that we have the ability to do in other software that we've built ourselves, and I'm not going to get into that tonight. But you know, even though you have the stop loss in place, it's still, you know, you still have a similar pattern here. So I just kind of get to, you just accept the risk. That's just my take on it. I'm here to show you all the things that I can show you, and you can make your own decision for what you'd want to do. But we can see that a lot of times having the stop loss, you end up with a worse win rate and ultimately less profit a little bit. And it's not that much less. But again, it's really hard to follow this the way that this software is testing. It's hard to follow that in real life. So I like to kind of go with, go with what I'm able to replicate as close as I can to the actual test itself. Can you close a trade during market hours? Yes. The software cannot. I don't know if that's what you're asking, Anil. The software it has a single price at the end of the day. That's one of the limitations of backtesting. So we talked about the 5 wide spread, and then what I want to do now, make sure the settings are right, is I want to do 10 wide, and and we're still using the 3 EMA. So I'm just going to run this. So a 10 wide spread is going to get you more credit because the protection you're buying is a little bit farther away. And the risk is going to be more because it's basically like having two spreads. So, but what I wanted to point out here though is, let me zoom down here. This is the 5 wide here, which averaged $60 a trade, and the 10 wide averaged $115 a trade. But the 10 wide actually had a slightly better win rate. And the reason why that is because when you have, the narrower your spreads are, your break even is going to be somewhere between the sold strike and the bought strike. When you widen that spread out, the break even point actually gets lowered a little bit. And so what we've seen over the past 5 years, according to this, is that that's enough to give you a slightly better win rate. Nothing crazy. It's probably, you know, 2 or 3 trades that probably weren't losers. And that doesn't mean you made max gain. It just means that the break-even point was lower. So potentially the loss could have been lower as well, or simply you could have had a bigger gain because where the break-even point is. So I did a video on this on YouTube somewhere, but I wanted to show you the 10 wide one. This is actually the one that I'm going to start trading myself because I think I like the idea that that the win rate's slightly higher. There's just, you know, it's probably like 1 or 2 points in the SPX. But, you know, you made about the same amount of money. And, you know, if you were to trade 2 of the 5 wide spreads, you have to pay 2 commissions. So even though the average trade here is 60 and this is 115, it's not quite double. I think the net, it's going to be like trading 2 because you're not going to have as many commissions on opening that trade. So I wanted to just kind of show you that version of it. I'm going to go back to the PowerPoint real quick. And I want to talk through the trade and just kind of just outside the backtest. Now that we've kind of seen the results of the last 5 years, the updated version, I'm going to be trading the 10 wide, but I wanted to show you both the 5 wide and the 10 wide. The 5 wide, you can trade with less money, of course. But here's the general setup. On Wednesday, near the end of the trading session, if the 3 EMA looks to close above the 21 EMA on the SPX daily chart, that means you're making that decision that day. It's not the day before, it's that same day. So if it looks like the 3 EMA is going to close above the 21, then you could consider taking the trade. You're going to sell a PCS, a put credit spread, with 7 days to expiration. That means it expires the following Wednesday. And you're going to do the sold strike. It's going to be 1 strike out of the money. In the software, we put delta 48, and usually, and I have a picture of this here in a second, but usually the delta 47 or 49, you basically want the one that's just out of the money. And the bot strike is going to be 10 points lower, or that's the one that I was going to be doing. You can also do 5 points lower, depends on what you want to do. And the backtest is hold to expiration. But as I said, there are times where I will take profits early. Sometimes if you get the wind behind your back on day 1, where you take the trade on Wednesday, and then Thursday and Friday are massive rallies, then sometimes I'll close the trade before the weekend because I don't want to risk, you know, what's left in the trade. So I still employ some of those, tactics, if you will. And again, when you come to expiration the following week, if it's Tuesday and I have a little bit of a profit, or maybe even, sometimes a loss, but if there's a little bit of a profit, I may consider closing, because at that point, the probability really is a coin flip between a max loss and a max gain. So sometimes I'll close there early too. But from the backtest perspective, it was holding to expiration. I'm trying to get more to that, but it's hard to do when you're watching the market move around. And we kind of touched on this, using the max loss of the spread as your amount that you risked. Even if you're using an intraday stop, I've seen these trades where you put this trade on Wednesday, and then Thursday and Friday just sell off, and you think this thing is just going to be a max loss. And then all of a sudden the thing turns around and it's not the following week. So it can be very volatile to watch, which is why I try to do as much hands off as I can. But ultimately, just know that max loss can happen because we're selling so close to the money. but the credit you're receiving is so much greater, the risk is actually less. And if we, if we were to sell a spread that's much lower, your credit's going to be lower and the risk is going to be a lot more, because if you're selling a spread and you're only getting $1 for the spread, that means you're risking 400. And yeah, your win rate might be a little bit better, but you are going to get some max losses, and those max losses are going to be bigger. Okay. So here's just real quick what this looks like. I just took a picture out of Tastyworks here. So here's what this would look like. In this particular case, the sold strike was a delta 49. That's one strike out of the money. And I bought the buying 10 points lower. So this was a credit of 350. That would make the max loss 650 for this particular trade. So, but again, if you narrow that and you sell 5 wide, your credit will be cut in half, but so will your risk. And then I put in here screenshots. I'm going to, again, put this PowerPoint over on the website, stockmarketoptionstrading.net, and I'll put it in the events section once I post a replay. And just to kind of show you what the back test looks like, I'm showing you the 10 wide one. And here were the results for the 10 wide for the 5-year period. And the dates are up here as well, July 30th, 2016 through July 30th, 2030. Okay, so that's enough of the presentation. Let's go back to the chat. There's a few questions here. How much capital would you allocate for one contract 10 wide? Well, one contract 10 wide, you're going to be risking, and we'll go to this example. You'll be risking about $650. So in Tastyworks, the buying power is $650 for this example. If you're asking how much capital would I allocate, that's really gets into everyone's personal trading plan and risk tolerance and all that stuff. I try to keep any one particular trade limited to 1% to 2% risk. So in a $100,000 account, if you're risking $650, you might do 2 spreads, and that way if the trade blows up for whatever reason, you've only lost $1,200, which was, 1% or so. You can do, I guess 3 spreads would be 2% in a sense. Have you tried 1 or 2 strikes in the money for a bullish scenario? We can do that. So what he's saying is, instead of selling slightly out of the money, let's sell slightly in the money. So let's go to Delta 51. We'll do a 52. So if we go back to, bring this back up. So a Delta 52 would be selling. So at this point, the SPX is at 4402 in this screenshot. So by selling the 4405, which would be the Delta 52, and buying 10 points lower, that means we actually really need the market to move up so you can get the max gain. But your credit's going to be more. So let's run that. So if the market does nothing, you could actually lose money because you're actually a few points in the money. Now, the cool thing about SPX is that it's cash settled. So you can be sitting in the money and you'll never get a sign because it's a cash settled product. So this actually did pretty well. 69% win rate. Your average gain was $400. So if we compare that to here, so instead of $350, your average gain's a little bit more. It made 11,000 versus almost 12,000 here. So it actually did not make as much. Am I reading that right? Let's see. This is the Delta 52. Yeah, Delta 52. So it actually made a little bit less, but it had more per trade. That was interesting. Oh, 94 trades. Huh. Something's weird there. I'll have to look that up. It did pretty well, but you have to be comfortable that you're trading in a more bullish manner. Are the EMA indicators to help account for the possible downturn of the market coming? Yes. Yeah, that's what the EMA is for. The EMA filter is to keep us out of any sort of extended bearish period, because ultimately this is a bullish trade and we want the market, if you're selling a strike here, over the next 7 days, you want the market to be flat or higher. And the moving averages can sometimes indicate that filters out potential, extended consecutive losses. Have you tried this on SPY? I don't recommend it on SPY because many times let's go back to this picture. Many times when you sell this, the market can actually dip in here below your strike, and you can be at risk of early assignment. So, I don't recommend this on SPY. However, you could consider XSP, which is just like SPX in the sense that it's cash settled. There's no early assignment. And if it expires in the money, you can let it expire in the money, and they just, they'll charge you an exercise fee, but you won't be assigned. But it has the same price as SPY. So you could do this with XSP. If you want to trade this in smaller size, in that case, you would do one strike wide. It's a tenth the size. So a one strike spread in XSP is a tenth the size of a 10-point wide spread in SPX. And that's kind of sounds a lot. Someone says, they'll have to tell me about their SPY assignment story earlier this year someday. Yeah, I've heard some stories like that, Freddie. Yeah, that's why I just kind of avoid a lot of that with SPY. I think if you're going to trade farther out of the money spreads where there's really not a risk of the option going in the money, I think it's fine. But we're selling so close to the money that I just don't recommend SPY. I recommend SPX or XSP. So, well, that's all I got.
It ended up being positive, but still could have gone the other way.
Sorry, say that again.
My story, it ended up being a positive story, but it could have gone the other way.
Yeah. So you got assigned. Was it a put spread, or how did that work?
Yeah, it was a put spread. I was like, oh, it'll close out on its own, and I obviously made that mistake. I was like, oh, it'll close out on its own, and it didn't. And then I got assigned on both of the strikes. The next one, I got assigned the next day on one of the strikes, and then for some reason there was a day delay on the other leg, and the market went back up the next day. I ended up selling at a higher price than I bought the other leg that I got assigned the next day. So, I made a profit on it, but still it was like $1,000 on a one point spread. Yeah,
for SPY. I mean, it's a lot of, when a lot of people try to trade SPY because they're trying to conserve their cost and keep the risk down. But if that thing expires, you let it expire where one strike's in the money and the other's out of the money, it's going to cost you to be in that. And, you're going to show up with 100 shares in your account, or they're going to be asking you for money. But yeah. So I just stick with SPX. There's also tax advantages to SPX. If you guys want to look that up, there's 60-40 tax advantage too. So I kind of ended up doing that. Jason asked, what about rolling up options is something I've tried. I've never been really good at rolling up. I mean, I guess you could do that in a sense. But, I think rolling, you're still basically closing one and opening another. So I don't know that it would be any different. I just try to keep it, simple, especially if you're going to close early kind of thing. You could try it. In theory, I guess it would be pretty much the same, but I haven't done that myself. Someone asked, can we try the 3 over the 8 EMA instead? Sure, let's do it. I'm going to do the 3 over the 8. And trust me, I've already done all this, and I ended up with the 3 over the 21. I did the 3 over the 5 over the 13. I did a bunch. Is XSP a 1256 contract? I don't know. I'm not sure what you're asking, Gene. It is like SPX, that it's cash settled. It's an index. It is an index. So I'm not, maybe that's what you're asking. So here is the 3 over the 8 EMA. This looks actually pretty good. 131 a trade. Very nice. Oh, I have to look at this one. No, I may have to do an update to the 3 over the 21. We're still on 5 years, yeah. 77%. Yeah, and this is, this is why I recommend anyone who gets into this, just, it's really helpful to get this software, because you can really go in here and play with things, and some people find things, because it's sometimes you get through these and you get all these numbers over here and you're like, okay, this one did pretty well, and it's like having to save it and all that stuff, but it's pretty, I think it's pretty educational just to go through this yourself, because you really start to see the different pieces of what makes money. And really what that is your wins, your losses, and how much you win when you win and how much you lose when you lose. That's really all this comes down to. So it's really finding what works for you. And yeah, this actually looks pretty good. Who's Walt? Good job, Walt. Thank you. XSP is a 1256 contract, same as SPX. Okay. All right, good to know. Would you do the same strategies on RUT, IWM, NDX? And the short answer is no, but let's do this. We're going to do RUT.
Do you have to look manually on Thinkorswim for those indicators for that 3-day exponential over the 8-day exponential, or whatever parameters you pick?
This was RUT, by the way. Oh, that didn't. Something's wrong right there. Whenever you see this, sometimes there's a glitch and we end up having to contact the software people. Still using on SPY. So no comment on RUT. I've tested other things with IWM, and typically SPY and IWM, they don't translate because RUT's often more volatile and choppy. So I wouldn't recommend this on RUT. With that said, I don't think this is accurate either. But sorry, the question about the EMAs. Yes, I look manually. I'll just I have different EMAs for different days, if you've seen my other stuff. So if I know it's Wednesday, and I'm doing the 3 over the 21, I'll just do a quick glance. Sometimes I have more than one. I'm like, okay, yeah, this, ultimately these are bullish. So yeah, I might look to take that trade. And then you have Fed days and things like that, where you're like, okay, do I want to take the trade? Do I wait? Sometimes I wait because the Fed, you'll get a lot of volatile action on a Fed day, which seems to be ramping up more recently, not as much in the previous years, but recently since Powell, there's been a lot of Wednesday late day fades. So, sometimes there's those market factors.